might be interesting for us to look at what a financial model looks like in the real world. So this is kind of a dummy model that I've put together, but that can give you some ideas of what an investor might expect to see. Now, before we jump into all these tabs, I'll also tell you that generally speaking, you're not going to want to send your model to an investor right off the bat. Anyone who's like, oh, I'm not interested in your pitch deck, just send me your financial model, I'd ask some questions before you do that. But say that you've had a good couple of meetings with them. They've seen your deck, they've asked good questions, they've come back to you and they've expressed a deep level of interest. In that case, they might ask for your financial model. And in that case, it might be worth sitting with them to go through your model before you just send it off to them. But some of what we're looking at here are elements that can be used in, like we talked about, that pitch deck, or even in answers to questions that the investors might ask you as you're going through these discussions, and those discussions are getting more detailed. So what we're looking at here, for example, is what an investor would consider a summary profit and loss statement, right? So we're just looking at the first 3 years. If you wanted to put it out 5 years, you can. I would have the 5-year numbers in your pocket, but I would not necessarily share them, just because some investors are like, how can you be focused on year 5? And then of course you'll get the investor who's like, I need to see year 5. If you've got them in your back pocket, you can just add them on here, and your life is easy. But I would start with 3 years. You'll notice that we're not getting any kind of level of detail, right? We're really just focusing on the high level line items. And EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is the heart of what's driving a lot of the investment conversation. So what you can see here, if you just look at our EBITDA numbers, and EBITDA, just, I don't know, I don't want to confuse you with the accounting jargon. EBITDA is basically considered kind of an equivalent for cash, because it's before you pay interest, before you pay taxes, or before you take any depreciation or amortization, which are non-cash charges in your business. So the whole idea here is that this line is kind of approximating the cash that you're getting, that an investor would see from your business. So as you can tell, in our business, the first 2 years, we're not actually making money, we need money. And as an investor, if I look at these two numbers and I start to say to myself, okay, well, so this is a company that's going to need about 1.6 million in cash, which is just the sum of those two numbers, to get to break even, right? So break even is when your company can actually cover all of its costs on its own without needing outside capital. And that's kind of the first step to a really attractive opportunity. The sooner you can get to a break even, well, depending on your business, but generally speaking, the sooner you can get to break even, the more exciting the opportunity is, assuming that you're still aggressively growing the company. So an investor would look at this and say, okay, great, so they're going to need 1.6 million to get to break even. They might, based on this, expect you to ask for a smaller piece of that, or given where we are today, since it's happening just over 2 years, they might expect you to ask for all of that cash right now. That's more of a judgment call about what your milestone is and how you plan to grow the business. But this is kind of what an investor is going to be looking at, right? So, okay, I see that they need this much money. And the other flip side of it is they see that in the very first year, once you break even, you actually make that money back and more, right? Which again tells a pretty exciting story about how quickly you're growing your business. Now, you can see also that that's dependent on very, very aggressive revenue growth, right? So as an investor, if I was looking at this, one of the questions I would ask you is, really, how are you going to 5x how are you going to multiply your revenues by 5 times in the first year, and then by 3 times in the next year? So I would have some questions, and I would want to hear your assumptions around how you're going to grow that aggressively. But this would be a starting point that an investor would expect to see probably in your deck, and then they would start to ask those questions based on what they're seeing here. So remember how we talked about this being an output, right? So the P&L, for example, is an output,